Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Hey guys, today we're going to look at balancing accounts. At the end of a lesson, you should be able to explain why accounts are balanced. Also, to demonstrate how to balance ledger accounts. Now, businesses go through this process of balancing accounts. Why? Why do businesses balance accounts? Whether the business is small or large, there are several transactions that they would have to record over a few months. Now, once you balance up accounts, that aids in breaking up entries into time periods. It also aids in determining the balance in an account, which provides updates. So for example, you would be able to know how much the business is owing to others, or the value of what is owing to the business by others, as well as to know, for example, how much cash is in the cash till, etc. So basically, it aids in determining the value that is in that account, the balance that is in that account. Now, it also provides a summary of information which is used to prepare the trial balance. So in order for you to prepare a trial balance, you would have to balance off accounts to know whether or not there is a balance in a particular account. And what you enter in your trial balance are balances coming from your ledger account. So definitely you would have to balance off your accounts in order to do your trial balance. Now we're going to look at the steps in balancing off an account. And guess what? There are 5 steps in balancing off an account. 5 steps. The first step is that you would have to add up both sides. Adding up both sides meaning total your debits in order to find out what is the total value that is on your debit side. Total your credit to find out what is the total on the credit side. Once you get those totals, what do you do with them? You find the difference between those two figures. After you find the difference, the value that you get is referred to as a balance. What do you do with this balance? You enter that value on the smaller side. So you're going to enter that value on the smaller side and you're going to call that your balance carried down. The abbreviation for balance carried down is shown beside here. So that's BAL CD. After you enter your balance carried down, now your next step is to enter your totals. And your totals must be entered on the same level. So you're going to total your debit side, enter the value of your total your credit side, enter the value of your total. Now, at this stage, once you have entered your balance carried down on the smaller side, and backtracking, once you have completed step 1 and step 2 accurately, meaning you add up accurately, you find a difference, you get the correct difference, and that amount is entered on the smaller side as your balance carried down. Then when you get to step 4 and enter your totals, both your debit side and your credit side should be equal. And your final step, which is step 5, is to enter your balance brought down, and that will be entered on the larger side, the side that is opposite of your balance carried down. So if your balance carried down is on the credit side, it means that your balance brought down should be recorded on the debit side. And this balance brought down comes after step 4. So it means that this balance brought down must be entered after your total, below that total. Okay, and once you have completed that, then it means that you have successfully completed the balancing off process. Now we're going to look at a few examples. So here we have a bank account with some entries, 1 on the left-hand side and 3 entries on the right-hand side. We're going to apply the steps in balancing off the account to balance off this account. Now, on the left-hand side, we have 6,000. So we're at step 1, finding out the totals for both sides. We have 6,000 on the left, and on the right-hand side, when you total, that is $2,850. Step 2, we're now going to find the difference between those two totals. Subtracting the smaller value from the larger value, which is 6,000, subtracting the 2,850, that leaves us with $3,150. That is the balance. And now we're going to make the entry in the account. Notice that for step 1 and step 2, nothing was written in the account. You start writing in the account when you get to step 3, and that is when you're entering your balance carried down. So let's enter that. It's at the end of the period, so we're using the 31st of January. The details is balance carried down, and remember, we're entering that value on the side that is short, with the smaller total basically, and the difference that you have generated in step 2 is what you're going to record here, which is $3,150. Now that we have completed step 3, we're going to move into step 4. And step 4 is where you record your totals. Your totals should be on the same level, meaning, like in this case, in the same row. Okay? Now, our total on the left-hand side is 6,000. And on the right-hand side, having entered the difference on that side because that side was short, our total is now $6,000. So once you get to step 4 and enter your totals should be the same, having completed step 1, 2, and 3 successfully. And the final thing is for you to enter your balance brought down. And again, that is entered on the larger side, which is the side that is opposite of your balance carried down. And also, please note that this value must be recorded directly below the total. So here we go. The date is the beginning of the next period, which is February 1st. Our details is balance brought down, and the value for the balance brought down there is the same thing as your balance carried down, which is $3,150. So remember, whatever you have in step 3 is what you record as the balance brought down on the opposite side of your carried down. Now, we're going to look at another example. And here we have an account for J. Brown. Now, we're going to apply the steps in balancing off the account. There's only one entry on each side, so that is easy for us. 350 total on the left and 700 on the right. The difference between the two sides is 350. The side that is short is the debit side, and that is where we're going to enter our balance carried down. So now is the time we're ready to record in the account. So that is January 31st. Our details is balance carried down, and the difference between the two sides there is $350. Now that we have that, we're going to record our totals. So 350 plus 350 give us 700. And the total on the credit side there is 700. Now, please note that once you record your totals, there should be a single line above and a double line below. To complete the process, at the beginning of the next period, on the opposite side of your carried down, your balance carried down, directly below your total, you write the balance brought down. So that is February 1st. Details, balance brought down, and the same value as your carried down, which is 350. So whatever difference you get in step 2, that is what you record as your carried down as well as your balance brought down. Now we're going to look at another example. And for this example, we have a capital account. Now in the capital account, we're only seeing one entry. And guess what? This is easy for you to balance off. So because it's one entry, you can see it is clear that your debit side is the side that is short. So basically, January 31st, balance carried down. And remember, we're entering this value on the side that is short, which is the debit side in this case. And the difference there is $6,000. Now, basically, we are almost there in balancing off this account, relatively simple. And the final thing that is left for us to do, because we have the entries in the same row, the same value for the total, there is no need for us to write total again. All you would need to do is to just double underline the totals. Just double underline the figures. I had a single line there already. So I just put another line there, and that is it. And the final thing there is to enter the balance brought down. So that is February 1st, balance BD, and the value there is same thing as your carry down, which is $6,000. And I'm going to look at one more account. Now, here we go with this account, and it is the account for Tayota Ltd. And we're in the process of balancing off. Now, looking at the account, look at the debit side and the credit side. What is the total? On the debit, we have $900. On the credit, we have $900. So it simply means that there's nothing for us to do, basically. All we're going to do is to just put a double line below those values because they're actually the same. All right. And in this case, there are times where when you are going through that balancing out process, having done step one, you would notice that your left-hand side is the same total as your right-hand side. In this case, we only have one entry on the left, one entry on the right, but there could be cases where you have more than one entries on the left, more than one entries on the right. When you total, you would notice that they're the same. All you would have to do is to just write in the totals and put in your single line above and double line below. And in this case, accountants, based on the accounting language, the account is basically closed. Closed in the sense that there is no balance in the account. So Toyota's account there is closed. Now, there is one more thing that I'm going to look at, and that is basically interpreting the balance that is within an account. So I'm going to go back to the previous account there, and that is a capital account. Now, we have balanced all this account, and the balance brought down is on the credit side. This is a capital account. The balance brought down is on the credit side. The increased side for the capital account is the credit side. And basically, the capital account, because the balance brought down falls on the credit side, the account carries a credit balance. So you can use the balance brought down to determine whether the account carries a debit balance or a credit balance. So in this case, because the balance brought down is on the credit side, the account carries a credit balance. Apart from that, capital account based on double entry rule increases on the credit side. So therefore, the capital account carries a credit balance. Now, in terms of debit and credit balance, you'll find this knowledge coming out when you're doing your trial balance just the same. Okay, now let's look at the previous account, and that is J Brown. We're seeing where there's a balance of $350, and we're focusing on the balance brought down. So we're looking at the balance brought down, and we notice that the balance brought down for this individual is on the credit side. So basically, this account is a liability account. The business is owing $350 to this individual. So it's a liability account. Liabilities carry credit balance. And here we're seeing the balance brought down for this liability account on the credit side. Now, to add to that, how is it that we know that the business is actually owing this individual and that this person is a supplier to the business? If you look at January 10th, you would notice that for this transaction, the entry that is in the account is January 10th, office furniture as details, and the amount is $700. If you should attempt to interpret this transaction, basically it is saying that the business bought office furniture on credit from J. Brown for $700, basically. On January 20th, the business made a payment of $350. So if you should attempt to interpret this one, the business made a payment of $350 to J. Brown by check. Now, if you look at this, you would notice that, yes, because the business bought the office furniture owing $700 to J. Brown and the business paid $350 out of what was owing, it means that they're still owing $350. So $350 from the $700 give you $350. So again, this is a liability account and liabilities carry credit balance. Okay, now let's look at the previous account, and that is the bank account. Let's interpret this balance. Would you say it carries a debit balance or a credit balance? Yes, it is a debit balance because the balance brought down is located on the debit side. Now, this account, looking at a title, it is an asset. Assets increase on the debit side, so therefore, assets carry a debit balance. Outside of that, the bank account can carry a credit balance. If the bank account carries a credit balance, meaning the balance brought down falls on the credit side, it means that the business has withdrawn more than what is in its bank account located at the bank. So therefore, it is now owing the bank that extra value that was withdrawn. In this case, the account would not be an asset, but a liability. And therefore, that credit balance is seen as bank overdraft. Okay, so once the account carries a debit balance, it means that the balance BD is on the debit side. If the balance BD is on the credit side, it means that it has a credit balance. Now, this $3,150 in the account is saying this is the value of what the business has in its bank account located with the institution, the bank account. Okay, and back to the other one, as indicated earlier, the business is owing J. Brown $350 based on what we're seeing there with the balance. For this one, we're seeing where the business has a closing capital balance of $6,000. And the final one there wasn't any balance in the account. This account is closed. So that takes us to the end of our lesson on balancing off an account. Remember, it's just 5 simple steps.
Like, share, and don't forget to subscribe.